Hello, everyone, and welcome back to SSI Meetup, where we host interesting discussions and educational presentations from leaders in the self-sovereign identity and decentralized identity community. Today, Alex and I are really lucky to be joined by Nate, the CEO and co-founder of Portabl. Nate's going to be talking to us about open banking regulations and how SSI can play a role in that. So we're really eager to hear what he has to share.
Yeah,
Before we get to that,
sorry about that.
Before we get to that, Nate, would you like to introduce yourself in your own words? And there you go.
Yeah, thanks for having me on. I really appreciate it. It's been a joy to watch some of your episodes unfold recently. And, especially in the past year or so, the SSI, self-sovereign identity, decentralized identity movement has kind of undergone its own mini explosion, if you will. And so, we're really trying to solve for the fact that open banking still has an identity problem, and we'll dive into what that actually means in just a few minutes. I've spent over 10 years in the space. The team has a collective, I think, almost 80 years in the identity KYC AML space. And we're excited by the kinds of ingredients we're pulling from the SSI decentralized identity world into a world that has been not the most progressive or fast-moving thing in the world, though it's a world where 300 million Americans do their finances on a day-to-day basis. So we're kind of playing SSI on hard mode as we figure out how do we get decentralized identity to fit into the identity-shaped problem inside the rules and regulations and constraints in the open banking universe. So I'm really, really happy to be here today and excited to take a deep dive.
Likewise, there's going to be lots and lots of good stuff that comes out of that, I'm sure. And for those who are just tuning into SSI Meetup for the first time, the reason we host these sessions is to share learnings, knowledge, best practice, and informational content for the benefit of the whole global SSI community. So anyone is welcome to come along and share their work with us. And likewise, we hope that everybody out there will learn from this, but also because we license this content under a Creative Commons by SA license, you're able to take the slides that Nate is going to share with you here, take anything else that you find on the ssimeetup.org website, and use that in your own work to share with your teams and to advance this course. So hopefully this will be a really useful resource. And if you find it that way, I hope that you'll be encouraged to share and maybe consider participating in the future. So with that, over to you, Nate, to kick us off.
Great. Thanks very much. So again, the way we want to think about this is what is living at the intersection of open banking regs and regulations, and where SSI can play a role in reshaping not just KYC, but really reshaping what identity management or continuous identity management means in the open banking and open finance context. So we're going to go through a couple of things today as I move kind of zoom from one window to the next. Self-sovereign identity, decentralized identity has a huge smattering of acronyms, and financial services is arguably even worse. So bear with me, and I guess all three of us, as we kind of go through this acronym bingo, because KYC, or Know Your Customer, and AML, or anti-money laundering, is going to get mashed up with SSI, verifiable credentials, or VCs, DIDs, and the rest. I do want to spend a little bit of time talking about what we're actually building at Portabl, kind of some of what's going on under the hood, what we're excited about and what's coming this summer. But I really want to focus on four areas, outside of just what are we building and why. And that's really to offer some broader perspectives on the open banking landscape and what the opportunity space looks like for an SSI provider like ourselves. So first, I just want to give a background to all of the viewers and listeners about, okay, what is the state of open banking? What does the identity problem look like? How has data sharing and data access moved from, screen scraping to APIs to, tokenized access? And why is data sharing and interoperability still sort of kind of a mess? What else can we do there? And so that kind of brings us to more of what we do that's not kind of a functional view, not kind of talking about our ingredients, really how we actually view the problem in a way to solve things that are very much outside of the status quo way of doing things. So specifically from our perspective, moving towards kind of a uniform way of verifying identity attributes at different points in the user lifecycle. And, as part of that, we'll talk about a little bit about how traditionally, you've had KYC, which is a part of the origination process, and then these kind of ongoing identity maintenance functions, all of which have been disparate and clunky and hard to stitch together. And so what is our view on making that entire continuum of identity transactions more uniform? That'll lead us to kind of one of our catchphrases we've been starting to really lean into, which is this tap to prove or tap to issue model. So what does this mean in terms of putting Portabl in context of the fraud and AML landscape? And not only how do we smooth out identity transactions, which we'll talk about in the previous section, but what it means in terms of building trusted identity networks. And that's really kind of the end state for us. We want to prove that users are good. Users should be able to, of their own volition, carry around their goodness and present that or proofs of that at any given point in time, kind of in an on-demand way. We would love to live in a world where we have communities of verified eligible users for different products and services that are trusted by different reliant parties and counterparties and peers without having to go through the same song and dance of end-to-end re-verification all the time. And the last thing that I want to reflect on is, what has it been like building Portabl? I got this idea kind of spun up in late 2020 into 2021, but it was really 2022 where the rubber hit the road for us all as a team. We built the team, we started shipping product, and there's a really fascinating concept, I think originated by Parker Conrad over at Rippling, around this idea of a compound startup. I want to talk about what that means in context of building an identity company, specifically an identity company that is playing on hard mode in the financial services space, and talking about how we view what it means to be a compound startup, and then how that affects our go-to-market, our productization, and what identity practitioners or other businesses who want to get started with us, what they can expect as we start releasing some more stuff in the public over the summer. So that's what I want to carry everyone through today. James and Alex, I'm really looking forward to the discussion. As I said in the top of the hour, I think off screen, let's handle each slide as kind of a basis for conversation. I'm not going to just kind of roll my way through everything. So let's kind of take each slide as it comes and we'll work it out from there. Sound good?
Awesome.
Very good. So first, a little bit more of an intro about what we're up to. So we think about this in terms of building shareable identity that moves at the speed of payments. The whole MO of why we exist is to simplify access and trust for end users of financial services based on reusable identities and the underlying verifiable identity networks. To put it in more concrete terms, we're building both the user-facing tools as well as the rails and infrastructure for issuers and verifiers to do what they need to do to kind of start leaning into decentralized identity approaches that make sense within kind of the strictures and guidelines of modern KYC and AML, and can be implemented according to the encyclopedia of guidelines and their own internal risk policies that they need to follow as part of being a financial institution, an NBFI, what have you. Where we would love to see this go and kind of the grand fullness of time, if I could wave a magic wand, is that everyone has kind of this universal financial identity, or kind of this superset of verified information about themselves that they can cherry pick from on demand to prove different things about themselves, whether it's simple identity, certain types of credit eligibility, up to and including complex sets of claims that need to be shared, or things like large loans, mortgages, insurance, stuff like that. Getting there is obviously going to take some time, both for us to build out these sorts of things as well as the industry to come around. And to put a little bit more of a concrete point on it, we know that in the financial services realm, there's a huge opportunity space, an unaddressed gap for an identity that's real-time, user-controlled, composable, and reusable on demand from account opening to account close. So we're really taking a longitudinal perspective on what it means to have credentials, maintain credentials, being able to self-aggregate from an end user's perspective, different credentials issued from different pieces of your financial life. You can agglomerate those over time. How do we simplify the maintenance of those credentials or updating those credentials, or in some cases, unfortunately, revoking them? And how do we make sure that consumers are empowered to use bits and pieces of those on demand to gain access to downstream services and things like that? Part of the puzzle for us is that this is an incredibly over-tooled space. You have KYC, you have IDV, you have fraud checks, you have third-party lookups, you have, a really long menu of systems and services that are usually used to evaluate customer identity, suitability, then do the authorization and the authentication. So we said, okay, there's too much going on. No provider on the earth likes having to stitch together anywhere between 10 and 15 systems just to onboard customers. So we asked ourselves, based on the standards that exist today, verifiable credentials, DID, OIDC, or really now the flavors of OIDC, what can we collapse together as a single offering that takes a lot of pain out from the origination process and maintenance process that is intelligible to the buyers that exist in the market? So when we go out to heads of compliance, heads of fraud, heads of user activation and say, hey, we do identity differently, we can say we collapse KYC, auth, and a couple of other things to provide you with a better system of both initialization and verification, as well as maintaining that trusted relationship with your users. And oh, by the way, we get them off of passwords because we know that that's a strategic thing for you and a source of pain. So from our perspective, that's kind of how we are going to market with this layer cake. Let's fill the hole with KYC, auth. Individuals can self-aggregate claims from different providers, and then users can keep their data updated. In exchange, providers get simpler, faster, more secure, and ostensibly privacy-preserving origination. They can offload some of the PII risk, and they have a different way of communicating with their users now because the identity can be updated dynamically outside of their own environment. I'll get to a little bit more about what that means in a second, but it's a really big step change and frankly, sort of a mind bender for some in the industry.
Yeah.
Because in collapse KYC and auth, we're saying, okay, hold on. For the first time ever, we're kind of, we're doing this sort of controversial thing of separating the notion of an identity from an account. And we're saying, okay, a user in Portabl has an identity. It's made up of some indeterminate number of verified claims. A subset of those are being shared with and kind of tethered to the account. And that's very, very different from the status quo, which is if you have 10 financial services apps on your phone, you have 10 versions of your identity floating out there. So we're saying, okay, how do we separate this out again to put more of the control back in the user's hands? And in uncoupling those two things, we can actually effectively smush together a lot of adjacent functionality for banks, financial services providers, apps on the other who would like to basically simplify the origination and management stack.
I mean, it's a real inversion of control almost, isn't it? Because you're not, as you said, you're not asking the user to authenticate with the bank's account for them. It's actually they're authenticating with who they are according to some authorities that the bank trusts. And in many ways that is the more natural way to do it, but it's just not how it's been done for such a long time.
You're exactly right. I have a mixed feeling about what we often get described as, and the people's first impression of what we're doing is, oh, you're building single sign-on for finance. Yes, that's true, but that's not comprehensive of everything that we're building. But it's certainly the easiest way to describe what we're doing, because you can go join an app or a bank or a NBFI or something like that with Portabl, and instead of doing all of the form fill and throwing information into a black hole and stuff like that, the intent here is to say, okay, I have this verified information. I'm just going to resubmit it based on the claim, the presentation definition required by the institution, assuming I have these claims, presentation exchange happens, and I've now effectively fast-tracked the most painful part of an origination process. I think for folks playing the home game who haven't spent a lot of time in financial services, the onboarding process is still really painful, at least by the numbers. For most of us out here, we might be able to join some fintech app or a PFM or personal financial management app in a couple minutes. Now that seems short to us, especially folks who are maybe, on the older side who are accustomed to really clunky things. But in the aggregate, joining a bank or joining like a fintech app, the best case scenario is still about 4.5 minutes. And then the worst case scenario is still, hours or even days. And that's because of all the maybes that happen. Things go to manual review, things have to get processed by a human, the applicant is stuck in a black hole. Because of those sorts of things, the attrition rate for financial services onboarding is still somewhere between 5 and 6 out of 10, which is like an enormous amount of money left on the table in terms of top line. And so what we're doing specifically tackles the part of that process that causes the most pain and attrition, which is form fill, data capture and gathering, and verification and authentication. Sometimes it's all bracketed together as something called SIP, or customer information profile. It's the thing that your average consumer plucked off the street hates doing with a passion. Filling in forms again, coughing up their social, digging around for their wallet, taking a selfie, like having to do all that stuff with UX that is oftentimes clunky, slow loading, incompatible with the device or browser, strangely worded, or somehow, otherwise confusing or, exclusionary. That's the reality of this situation we live in. And so we said, okay, if we can now simplify that whole annoying SIP process by saying, okay, everything now lives as a set of verified claims. If you can, in like a single modal from our perspective, you can say, yes, I consent to sharing this bag of stuff. And so we've now compressed that, SIP verification and consent to a single action. And so we expect that to have a huge ramification in terms of smoothing out that onboarding.
And you may get to this later, Nate, but of the three different sort of main benefits for financial institutions that you mentioned, the account origination, the authentication, and the maintenance piece, it sounds like it's the onboarding bit that you lead with. That's sort of the biggest benefit that these folks expect to receive. Is that right? Or actually, do you somehow find a stakeholder who has purview over all three, and that's kind of how you go in?
So that's a challenging one, and the answer to that is somewhat counterintuitive. It's very easy to talk about onboarding and origination because it's the single biggest kind of top line benefit that you'd expect to see. However, the funky thing is that it's not just a problem that Portabl has, but every type of identity company, particularly reusable identity company, has, is that you're not going to smooth out originations at scale until you have a boatload of consumers in the ecosystem using the app of the service or the credentials of the DIDs or whatever. And so, okay, you have this super chicken and egg problem that frankly all SSI providers have at some level or another, and it's particularly difficult in financial services. And so really where we're going with this is, while Portabl can offer this sort of highly secure fast lane for originations as intended, the main things that we're seeing in the market right now actually are coming from all of the superpowers you get through issuance, not verification. And so for us, that's a huge, huge deal. And I think we'll spend some time, in a slide or two, talking about what we're seeing in the issuance landscape. But when you think about being able to issue an identity back to your user and say, hey, James, Alex, you're not a bot, you're not fraudulent, I trust you. And now I'm going to basically subscribe to this credential as it changes over time, and I can continuously re-verify you. This now unlocks a lot of other stuff. One, it unlocks a lot of bottom line benefit. And one thing, we released an article in, I think it was actually in Forbes, like 3-4 weeks ago, about perpetual KYC. It's been kind of this thorny, like white whale of a problem in financial services for 20 plus years, really since the Patriot Act kicked into effect. The question is, how do you maintain a single customer view or a clear, updated set of data on all of your users according to your risk policies and risk profiles? Before I jump into this, I actually want to make sure I'm not ignoring anything else. Okay, we'll get back to open banking in a second, but I will talk about why issuance and perpetual KYC is really important to us. And it's frankly for the fact that FIs and any type of financial service provider usually spends a disproportionate amount of their time and energy focused on maintaining and monitoring identity and other related information about customers deemed high risk and medium risk. And that's anywhere between, say, 10 and 20% of the end user population. The next, let's call it 80%, are low risk, normal folks like you and me. The problem is, at scale, providers have a hard time knowing what is still correct about all of these users. And if you have blind spots across 80% of your customer base, you effectively have a lot of latent risk and risk of fines. And as we know, the regulators are very fond of finding institutions for non-compliance to set examples. And so from our perspective, what we're seeing is that, wait a minute, by issuing identities, we now kind of create these more sensible real-time tethers with users, rather than having this kind of stagnant black hole of user data. So it's in the FI's best interest to issue as many credentials to their users as possible, to get as much of their user base as possible into a real-time basis. The anecdote I'll offer here is that years ago, when I was working for another kind of KYC, KYB company, the head of compliance and KYC for a top 10 global bank, just kind of extemporaneously said, I wish people had their own APIs. Well, that's an interesting idea. And that kind of sat with me. This was maybe 2018 at the time. And that just kind of drilled its way into my head, lived there rent-free, and has continued to live there and take up space. And then we started building out our credentialing engine. We said, wait a minute, issuing credentials and then figuring out product-specific ways to allow people to update stuff smoothly and republish those claims back to reliant parties is in effect building a verifiable feed of user information that is permissioned by default. So that is kind of our big MO right now, is understanding what kinds of value-added services can we build on top of issuing to get to the critical mass that now makes verification and simple origination a much more common reality. So that's kind of our take on how do we break through the chicken and egg. So I'll pause there. I'd love to know, get some feedback from you guys, your impressions there. I'll kind of blow through this afterwards about like our tooling and how we're set up and how you get started. But I also definitely want to make sure we can jump to the fun open banking stuff.
What are the main arguments you're using right now, or you plan to use in the future, for financial institutions to collaborate? Because when I checked your website, it was saying, right, you have like humans and businesses, right? I understand businesses is mainly financial institutions or financial related companies. Why should they sign up, right? Because the argument of institutions not wanting to handle all the problem of toxic data or hackable data or the whole process of spending money on all that has been around for a long time, right? But at the same time, it's also very convenient, because if you make the data portable, literally, it's not so cool, right? Because they can leave your financial institution really fast and go anywhere they want for the best, whatever, interest rates and so on.
Yeah, so this is a great question, and we'll bring this up when we get into the real meat of the open banking issue. But the one-liner here is that banks and other FIs have been relying on quote unquote someone else's data for as long as we've had aggregators and consortiums. So that's kind of the part one. And then part two is that fraudsters are getting smarter and faster. These two problems are going to intersect, which means we're going to have a garbage in, garbage out problem unless we enable the population to have a verification that travels with them. So that's kind of the background context to this. The objection of, I don't want to make it easier for my users to leave, is a really common one. But the numbers don't actually hold up to the objection. And so I'll come back to that in, I think, a slide or two.
Gotcha. And what about regulators? I mean, just one more question. I mean, because I've noted now a lot of questions, just this one more. What are the hurdles or non-hurdles that you have with regulators in addressing the issues and having financial institutions reusing these credentials? And I mean, what do you have to fulfill from a regulatory perspective? Let's say for the US only.
Yeah, so great question. I'll skip this for a second. The short summary here is we deploy like SaaS. You get a dashboard that gives you configuration tools, API keys, things like that. No surprises. We wanted to make it as normal and as intelligible as possible to use us, even if you have no background in SSI, VCs, DIDs, any of that. So more about the regulators, which I can talk about here, because I kind of call out some by name and some other regs. And then we'll get into some other stuff later. So the regulators in the US are an interesting species because they cannot provide prescriptive standards for how to do things. You know, I think the industry punching bag is the phrase a risk-based approach, because it's both everything and nothing in terms of how FIs, other reliant parties in the industry, design processes to evaluate candidates, maintain the data, maintain the integrity and security of the data, and then run a book. So that's part one. Part two is, one thing we're keeping an eye on is not FinCEN, not the OCC, the CFPB I'll come back to in a second, because that's a separate thing we're excited about. But it's actually the Department of Commerce that we're interested in, you know, their actions. Because the Department of Commerce runs NIST, which is the kind of the digital standards powers that be. They're the ones who, so right now, I think there's an open proposal for formalizing verifiable credentials as a secure data sharing mechanism. And so for us, that's an enormous deal. Because if that successfully goes through, and we expect that it will, it now opens up a whole opportunity space for like VCs to be like a equally legitimate way of moving data about the ecosystem. So that for us is a very big deal. That's kind of one of those like lower level things that we're very excited about. The higher level things that we're excited about largely stem from the CFPB vis-a-vis Dodd-Frank Section 1033. Section 1033 is a funny beast. It's basically like 3 sentences in the larger larger Dodd-Frank financial reform bill, but it's those 3 sentences that kind of set the bedrock for what we might consider, you know, US's version of PSD2, effectively. And so as it stands right now, Commissioner Chopra has been very vocal that we need to move toward an industry in the US where banks don't own your data, Plaid doesn't own your data, Akoya doesn't own your data, but you actually own your data and you have freedom to roam about the cabin with your data, shop around, you know, break up with your bank, find the like product or service that's best for you. But we're not there yet. You know, Dodd-Frank 1033, the final ruling comes out some point, I think it's January of 2024. So everyone's kind of on the edge of their seat waiting for this to happen, because it will have a major effect around how open banking can be in the US. And that's what's happening at sort of a macro scale. Again, we don't expect that one to have any prescriptive advice about use this standard, don't use that standard, blah, blah, blah. That more will fall to NIST. But if these two things actually coincide in ways that are more progressive than not, then it means kind of we're like immediately on the bullseye come January 2024. So that's kind of what we're seeing from a regulatory side of things. I think in terms of like being an identity practitioner and speaking to KYC and AML individuals, The biggest thing that we're doing right now is proving that someone who onboards using Portabl, so presenting a bunch of information that complies with a SIP program that's nestled within the larger KYC AML program, which is nestled inside the larger BSA program, that you can achieve what's called, according to the CFPB, outcome-based equivalence. So effectively, that means for anyone applying with Portabl, but using Portabl versus the old-fashioned way of like form fill, so on and so forth, are you reaching the same decisions? And so is there not like a skew one way or another for users coming in via Portabl or coming in via the old-fashioned way? It'll take longer for that to sort out. And so we'll need to generate the volume to prove outcome-based equivalence. And so that's going to be something we will collaborate on a lot with our earliest adopters. So that's yet another piece of the regulatory puzzle that we're trying to consider. The final piece, and I think I've rattled off like 5 or 6 at this point, is bearing in mind things around AML, BSA, and everyone's 3 favorite numbers, 314 or 314 A and B. And those are the AML kind of subsections that provide steering along when and when not institutions are allowed to share data, either with each other for anti-money laundering purposes and bad actor identification, or with Treasury for escalated AML cases. Verifiable credentials are kind of a funny beast, because if I take a credential from A bank and I go join B app, it's not like B is taking data directly from A. I think every verifiable credential practitioner knows that to be true. However, folks in the financial services industry, that hop is not always intuitive to them. And so there's this kind of, moment, I'll describe it differently. The notion of reusing data somewhere else spooks some people. And I understand why. There's a lot of questions. Is B pulling data from A? Does data lose control? Does A lose control of their data? How can you be sure that like B is asking for the right things? There's all sorts of questions that come up from this.
Well, and the great one, if A's data was inaccurate, can B sue A? That one.
Whole mess of liability.
Yeah.
That comes up with this, and I think I'll end on liability before talking about more of the genealogy of conveying this data. And from our perspective, the way we get around that, at least for the time being, is by doing this non-intuitive, controversial thing, which is not having our own decisioning module. And so this allows banks to say, oh, this is verifiable credentials are interesting. They're not something I'm familiar with, but it's just another way to be a data provider. But a person is a provider of their own data, is really what it comes down to. And that's probably the biggest reframing task that we have ahead of us in terms of go-to-market, product marketing, and enterprise sales, if you will. It's that the person's data is their own data. It's effectively watermarked or stamped, cryptographically signed, pick your metaphor, by some other sets of issuing parties. So the data is authentic. You can ask for whatever you want to ask for. But at the end of the day, you, reliant party, still need to implement Portabl according to your own risk-based approach. And that because you're consuming these credentials, you still need to crunch it and say, is this person, eligible or not? We can't tell you that. At least that's the business decision we've made at this point in time. And so that's how we get around some, not all, but a lot of the risk of the classic, how can B rely on A? It's not perfect, but it is sufficient for now. And I think there's some, some low-level considerations around data quality and data provenance and even data redundancy that we're also thinking about, in terms of ways of, beefing up the data or the data's reputation to make it more easily usable by some other reliant party.
And I guess sort of semi-related to the liability question is that of just compensation, frankly. Like, do you end up in situations where A expects to be paid by B if B is benefiting from that data?
So we've been asked that question a few times, and it kind of makes me queasy, if I'm totally honest. For the viewers at home, you can quote me on that. It's complicated, right? So one way of interpreting it is, okay, A is now a root of trust for a certain population of individuals in the ecosystem. Okay. So if A is now vouching for, say, 100,000 people, and those 100,000 people go out, and bundle some other financial services powered by their A ID or their A credential, I could see why A would want to get paid for that. It does open up a really gnarly question, though, about how do you do this, if at all, in a way that doesn't break the Bank Secrecy Act. So that's like one thing that is very challenging that we don't immediately have an answer for. So how we get around that, at least for now, is understanding from like A's perspective as an issuer, okay, what kind of other economic value can you unlock by, implementing Portabl? So instead of saying getting paid by downstream verifiers, it's how can you accrue more top line or bottom line benefit from using us? It's sort of like a proxy to just like straight up getting paid by your end user being successful with downstream originations. Mm-hmm. The other thing, I think, to put a finer point on why it makes me queasy is actually something that, we're looking at from certain use cases involving tokenomics around, okay, does the incentive structure line up that would actually be beneficial for end users if A gets paid more for successful downstream verifications of their own users? The jury's out is really what it comes down to. On one hand, trying to figure out how to frame this one up. KYC and AML done poorly carries a lot of liability. So we don't want to like taint that process for A by saying, oh, if you actually onboard more people and create a big affiliate network, you're having another revenue stream. That's really complicated, and we want to make sure that A doesn't dilute their processes just to have more identity transaction volume. That's kind of an anti-pattern moral hazard thing. We would love if we lived in a world where that was much more of a unsubstantiated fear, but for now it's all very hypothetical. We don't know yet. So that's why we don't have payment rails in the Portabl system. It's priced as an API, it's usage-based pricing, and we will work with you to figure out the economic benefit that you as an individual institution will reap from your bottom line changes and your top line changes. But for now, that is the least risky, kind of most common sense thing that we can do. I think,
and it keeps the conversation focused on the benefits, right? Not just some ancillary and, in the grand scheme of banking, quite small revenue stream, but actually, what change are you hoping to affect in that customer experience? So that makes a ton of sense, and it jives with some of the experience I had in a previous life. But it's really interesting to hear that it still plays that way on the other side of the pond. So super cool.
I don't want to discount the ability to build identity networks or like affiliate networks on top of, say, gray labeled or white labeled IDs. So if I'm, XYZ bank, I don't want to like name a bank, and I'm saying, okay, instead of being a sponsor bank, I'm actually going to be an issuer bank and build services and networks on top of issuing credentials to my users. I'm going to target some PFM, some lending, some other stuff out in the universe, and figure out preferential ways for individuals with their XYZ ID to join those apps and services and get perks, benefits, blah, blah, blah. And then however that works out, I, as an issuer at XYZ Bank, can also have an economic benefit. That is less spooky to us here at Portabl, because that means it's not direct remediation. It's second order economic benefits by relying on the integrity of the issuer verification network. So it requires a little bit of explaining and differentiation from, I want to get paid every time my credential is used somewhere else. But I think that if we wanted to go forward with a way where the issuer gets some kind of economic benefit that comes from network effects, that's probably how we would set that up. But that's going to take, a larger adopter pool and some very, very careful experiments.
Yeah, but that is a lot. It's like the difference between paying for a warm introduction versus paying to just have someone's address book, right? I mean, it's not money for data, and I think that makes it much more palatable for sure.
Exactly, and I think it also, doing it that way may present some opportunity to safely allow people to self-monetize. I know that's kind of a big philosophical thing in the broader decentralized identity community of, I hold all of this valid data about myself, I should reap some value from it. I think the jury is still out in terms of whether that's like ones of cents or like tens of dollars per transaction. However, if I can use my XYZ ID, or, use my XYZ ID and my something else ID in combination to join another service, and in doing so get a couple like bips off of an interest rate, or get, $10 of free stock or coin or something, well, that's different. I'm not monetizing my data, but I'm getting second order monetary benefit from using verified information rather than going in the long way. How that happens is because I bring trust to the transaction natively, and the reliant party can spend less money verifying me, which means now you have economic surplus that you can redistribute through perks, benefits, things like that. So that's kind of our longer view on, okay, if we get credentials right and we can make good use of the trust triangle in financial services, payments to issuers or payments to holders come from the second order effects you can build on top of it. So I think with that, I do want to just offer a little bit more about what's going on in this slide, because it's kind of been hanging here, gathering dust from our last bit of conversation. I think the first thing that I've already kind of touched on pretty decently is that just identity is a complicated mess in financial services. And I think, Alex, to your point, it's not one agency's job or one business unit's job. You have 5+ different agencies in the US, all have caring about identity in one way, shape, or form. And then within individual organizations, identity kind of has this annoying everyone's and no one's job. You do have people who run KYC or customer activation. You have people who run AML programs. You have people who run fraud programs, obviously. And then you have a whole battalion of people who handle all the maybes, the edge cases, the manual outreach, stuff like that. And that can be deployed across all sorts of departments and business units. Problem is, it's not a business unit. Identity kind of has this tragedy of the commons thing going on with it. That's kind of what's going on institutionally. And then, the past 20 years, how we allow information that might live inside your DDA account or checking and savings, how does that get somewhere else, to a brokerage, some fintech app, an exchange, what have you? Obviously, it started with things like screen scraping. I'm very happy to see Plaid's recent announcement that it moved a bunch of like super major banks off of screen scraping to APIs, which is good for everyone. I think it was about a year ago or so that the industry took another step forward with open banking connectivity, and that was through the use of processor tokens. MX, I think it was about a year ago, made this announcement that through the MX processor token, a third party can consume different types of identity or account information without having to hold the information or deal with it in like an unencrypted way. And so I think that was another good step forward in terms of privacy preservation, data security, and risk mitigation. And I'm really happy they were able to do that. If I'm not mistaken, they did that in conjunction with Move. So shout out to Move. Awesome set of developer tools. Keep doing what you're doing. In the meanwhile, we had a lot of standards stuff go on at the same time. We had the FDX do what the FDX does, which is in terms of developing the financial grade API standards that makes data interoperable between institutions. More recently, we've had Plaid and some other organizations build out the OFDSS, if I get yet another acronym right. It's the Open Finance Data Sharing Standards, which we play by as well. So needless to say, there's a ton of super brilliant people worldwide contributing to, okay, how do we make sure that data from over here is intelligible over here and can securely be consumed? This kind of goes back to my point, Alex, from the top of the conversation, is that whether we like it or not, open banking already relies on trusting on someone else's data. And so this is the wild thing to me when a potential issuing party says, so wait, I'm just going to let B rely on my data, or vice versa. B says, so I'm just going to rely on A's or whomever's issuer's KYC. Well, it's like, yeah, you probably already do it anyway. If you're using Plaid, if you're using MX, if you're using Akoya, if you're using half a dozen other things, you're subscribing to a middleman that is ingesting someone else's data. It's an aggregator thing. It's a consortium thing. It's a standards bodies thing. We're already doing it. So the real question is, kind of comes down to this, dashed blank over here. It's what is the future of getting data from A to B that might be someone else's data, but how do we stop it from being someone else's data and turn it into that actual person's data? And so this kind of brings me to the next thing that we should dig into, which is that if we can stop and consider verifiable credentials and DIDs as a new type of data form factor, then it allows us to start moving in a direction to move the conversation away from bank verified data, which is what we've been doing for 20 years, to any type of provider verified data that comes along with the person. And so, I think first bit here is kind of essential, is that in no way is bank verified data going away. That's still kind of the mother lode of most people's data are their DDA accounts. That's not going to change anytime, I think, in the short term. It's going to be there. But more and more, there's economic activity that's happening outside of people's DDA accounts. This much is obvious. I think I can't remember what report it was. I think in maybe like a liminal report, it was people have like on average like 8 fintech apps on their phone. There's some other studies that put it between like 13 and 20, which is much higher. The point is that produces a lot of data, what's called data exhaust, or just all the data that's thrown off of those verification processes, transactional processes, user processes. All of that stuff has some like pretty serious ramifications in terms of making itself available for decisioning, suitability, stuff like that. And we're starting to see some of it already from things like alternative data credit underwriting that uses cash flow information to say, okay, absent a credit score or in presence of thin file, what else can we learn about this person to define suitability? So those are kind of the things that are happening as a backdrop. And so the question we pose to ourselves here at Portabl is, okay, between existing types of identity information and bank verified information, account information, and then this whole spectrum of other exhaust, which is transactional, behavioral, device, what is the path forward to boxing this all up in other types of form factors that are continually user first versus kind of one-time user first, which is kind of the traditional, yes, I allow Robinhood to sign into my stuff using Plaid and pull on this data and set it and forget it. So, we are effectively then on mission to standardize the interoperability of things like identity, suitability signals, account attributes, and like anti-fraud stuff, but make sure that it comes along with the person is really what it is. So this is kind of taking, this idea of, open banking data sovereignty or the Dodd-Frank 1033 ethos to an extreme, but we think it is not just like plausible, but the direction we need to go, so that consumers can have more agency around how they manage their own data, how they share things on demand. And it gives reliant parties and the rest of the industry a lot of flexibility in terms of what and how to verify what things when and for what purposes. And I think to summarize, it really comes down to these three things. The one we've talked about a lot, which is onboarding and origination. Reliant parties want to treat new users as well as known users. The best way to do that is allow for verified information around identity, accounts, payments to come along for the ride. If you can get all of this context in a single go that is user permission and then dynamically updated, it's way better than what you can do now with less attrition. Beyond that, one thing we don't talk about very much, but it's plausible, is that you can consume a credential, make sense of it, and then say yes or no to the person, but you don't necessarily have to hold on to it. And that's kind of one of the like quiet, sneaky things that probably is not talked about enough. It is true that in financial services, FIs and other parties have to have record retention for 7 years. One of the bets we would like to make is that what record retention actually means is going to change. The reason why we think that is for the same reasons that cloud computing is now much more the norm than on-prem. So I think, if any of us could flash back 10, 15, 20 years, I think any major bank on earth would say, we have our own servers in some warehouse in place. It's our hardware, it's our servers, it's our, everything's. And now flash forward to today, and it's much more mixed out there. Major FIs, major financial services providers are embracing cloud, and not just, private tenant, but, public cloud with logical segregation and all the security bells and whistles that go along with it. So what that means is that the definition of retention in my data is being separated out from bare metal itself. Similarly, we expect this notion of record retention for identity data to change as well. Not having it like on my server somewhere, and then God forbid, like emailed in a spreadsheet to someone else in the back office. But no, as long as I can maintain permissioned access to these credentials for 7 years, that satisfies my requirement. I'm subscribing to a user even if they've closed the account, and I don't have to store it. That's great. That's a little further off. I'm sure that whole concept sounds like going to space for some compliance professionals and AML folks in the world. And I'm sure I've given at least one BSA officer a heart attack. Whoever that is, I apologize. But, 2023, no, we're not there yet. But by 2020, 2030, I think things are going to be very different in terms of what record retention means. Final point is the lifecycle maintenance stuff. It's very expensive to keep your customer base up to date. Single customer view projects fail as often as they succeed. They turn into money pits. They're just painful across the board. The easiest way to solve that, like I mentioned, is to issue credentials, empower your users into identity ownership and management, and then you get that real-time permission feed and exchange. So that's kind of our general view on it, given the context of what's happened before in terms of how identity data is gathered, standardized, collected, and reshared. So, again, impressions here, even,
yeah.
Back.
Well, look. So I'm hearing a fantastic setup in terms of like there's appetite. Clearly, there's sort of regulatory conduciveness, for want of a better word. Like this is clearly skating to where the puck's going, and there's available plumbing, right? As you say, like a lot of these primitives exist now and are genuinely a better mousetrap than the old way of doing this, which is super cool. But the missing piece, or I don't know if it's missing, this is presumably the gap you're going to talk about how you're filling, but is the actual tooling, right? If we're going to give end users this agency and this sort of personal API, then that part has to get built out, and the control surfaces for that and all those bits. That's in some ways the cherry on top, but in other ways like the most important piece of this, because it's so visible and so much will depend on how users accept that or not, right? So I'm curious to hear how you think about that piece, and also how the FIs that you partner with think about who should control that piece versus, you guys as a provider versus them as the brand of record, as it were, for that customer relationship.
Yeah, certainly. So this is the tricky one, because I think this is kind of where we'll sort of move into this slide, that we've mentioned some things about this already. I guess the thing that I'll open up with is that applying self-sovereign identity to open banking means that the notion of sovereignty has to change. I think there are definitely like SSI maxis out there who are just like, my keys, my data, my like all the things are on my device. And that's kind of the beginning and the end of the conversation. I shall not surveil and all that. I get it. And that's, I think there's a grain of moral outrage in that I vibe with. Part of my career was in ad tech. I built a real-time DMP, and the amount of data that people throw off that they don't know that they're throwing off in browsing sessions, for instance, and that is just getting like hoovered up by like publishers and other companies, is nuts. So like, I definitely get the like, I'm kind of tired of being surveilled vibe. Totally get it. But as it is, the financial system is a set of social and legal contracts, thou shalt not launder money, things like that. And then reliant parties have duties to themselves to maintain, liquidity, to maintain good practices, to maintain good risk profiles, offer good services to users, and keep those users safe. And so I think the thing is that VCs and DIDs are like a great form factor for solving some of this stuff, both in terms of like point in time trust, as well as the longitudinal trust that we've talked about in terms of, periodic refresh and ongoing monitoring and things like that. But it's going to be hybridized. I think if VCs and DIDs work in the financial services industry, one, it's going to be a very balanced approach in terms of the data sovereignty type experiences that users should expect will be much more akin to like a super juiced up version of like 1Password or something like that. But instead of passwords and authentication credentials, it's now signed bits of data. And I think the predominant design paradigm of like a wallet, sometimes it gets knocked, but it's very easy for people to understand, especially if you look at it in terms of payments. So like if I have a Venmo account or an Apple Pay account, I have a bunch of payment methods. If they're branded, they might be wired to other downstream services. I have a wallet, I can scroll through them. I can deploy different payment methods to achieve specific transactional goals. That's very one-to-one with the intent of using credentials in financial services. Hey, I'm setting up an account at this like remittances app, and I need to like slide over my banking credential and something else. Okay, cool. Composability on the fly. It's like paying for something. So we have to put it in both kind of semantic and experiential terms that don't spook people. Like that's the first thing. And then the second thing is doing the same thing, but for FIs of, hey, these are APIs, you get, a web dashboard, you get a case manager, you get, deployment guidelines. If you can set up, if you can set up Okta, you can set up Stitch, or you can set up Alloy, you can set up us. It just so happens to be that what's going on underneath the hood is very different. So I think those are the two things that have to happen. And I think those two things are not shocking, particularly when taken into the context that other attempts at identity, particularly those deep in Web3, just have super subpar user experiences. I need to log into this, to do that, to unlock MetaMask, to move this thing over, to look at this wallet address that looks like my cat walked on my keyboard. I don't know what I'm doing anymore. And does this button break something? that kind of stuff is not going to fly when people are used to things like connecting Robinhood to their bank using Plaid, and that takes like 30 seconds. So from our perspective, our go-to-market and the angling and framing around it, it's much more about security and ease and simplicity than it is around like, taking back your data, if you will. And so I think that's kind of the stark reality of getting this to work in financial services. And I think that's why I have the thing down here about this. It's a balancing act between how do we use this technology to bring a lot of consistency to a lot of different identity transactions in ways that are simple and high trust and familiar, better than what we can do now. And, people really like their payments metaphors. And so, we're really leaning into that. I think composability is not something that is talked about enough, even though it's kind of a key defining criteria of verifiable credentials. That's one thing we think about. And I think this brings me to kind of one thing down here that I think, James, you're kind of eager to dig into, is that in applying DIDs and VCs to financial identity, the experiences have to be very intelligible to people at the surface layer. So looking at payments, looking at other kinds of identity developer tools from the reliant party perspective. But what this also means is that we should probably expect an expansion of the issuer holder verifiable model. And so one thing that we are thinking about, and again, this is more hypothetical work in the Portabl lab than anything that I would want to like commit myself to, is that if we are going to introduce kind of sets of identity practices and procedures that are like uniformly consistent from origination to closing, then we need more than issue holder and verifier. And it means we need something called a broadcaster and something called a registry keeper. The broadcaster for us, at least for now, is largely synonymous with the holder, but it doesn't have to be. And so this is kind of where a focus on walleting is merited. Because there's one thing to say, okay, I have a credential from A, I'm going to reuse it for B. I could do that over and over and over again. And now I have like 7 accounts linked to my Portabl wallet. Now what? Okay, if I move, if I have a new driver's license, what is the easiest way for me to let those 10 reliant parties know that I have a verifiable update about myself? And so that's kind of one thing that we're working on around kind of being able to kind of bulk update things as a holder. And so this is what we mean by being a broadcaster. It's not just your holding credentials. How do we build capabilities for you to like republish stuff in a verifiable way without having to do it on repeat? Because people hate the repeat problem on origination. We don't want to move the repeat problem downstream to the updates. So that's one thing we're thinking about. The registry keeper part is more about the trust registry. And I'm thinking back to actually a tweet maybe yesterday from Riley over at Trinsic, where I think the crux of the tweet was that in the identity space, this was a generalized comment, not financial services, that there will always be middlemen. And I agree with that. There will always be middlemen for identity services. The question is, are the middlemen the identity and information brokers, which traditionally they have been, and it ticks off a lot of people? Or do they become the rails on which people can interoperate with data that's self-held cryptographically? If it's this latter, then the middleman has to be the registry keeper. So are the issuers verified? Are the verifiers verified? And are the holders all authorized to operate within this registry? It's kind of one of those things that is implicitly created by the trust triangle, but I think in financial services, it has to be much more formalized, because that will end up taking the place of what we have now around things like the financial data exchange or other types of like bank consortium things that have traditionally shared data in whatever ways they've shared data to some effect. But if the whole like SSI thing hits in financial services, we should expect consortia and bureaus to become registry keepers. And so that's kind of our provisional thinking around moving from this kind of 3-node model to this, 4 or 5-node model, necessitated by just the regulations, risk, and liability in financial services.
So I've seen that trust triangle expanded into more of a trust diamond with the registry, or I think Trinsic call it the provider role. But yeah, that sort of locus of centralization for a given ecosystem kind of sitting underneath at the bottom. It's the bit that bridges from the issuer to the verifier, and that sounds a lot like what you're describing there with that registry keeper role. With the broadcaster, should I be thinking of that a bit like some people draw the contrast between a wallet and an agent, where the wallet stores stuff and is pretty dumb, other than, these things are secure and cryptographically signed and you can bring them with you. But the agent can do things on your behalf, like the rebroadcasting, like the permissioning, and so on and so forth. Are those two synonymous, or are you thinking about the broadcaster in a way that is separate and distinct from what some communities call an agent?
I would say they're approximately synonymous. I think for all intents and purposes, your description of that is right. We don't terribly like calling the wallet a dumb container, but I think we want to also just I'm trying to figure out a way to work through this. So the agent does kind of the publishing to whatever accounts need to subscribe to a specific claim update. Sure, that's agent to agent communication. I think 1 out of every very large number of people plucked off the street will actually want to get into the meat of that distinction. I think if any average consumer was in one of their apps and said, and it was, it could be a payments app, it could be any sort of app, and said, oh, do you want the blah, blah, blah agent to do this for you? That's going to probably raise more app confusion than app benefit. It actually kind of reminds me of the old Windows errors from the 90s of blah, 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 X agent has experienced an error in decipherable error string. Folks in the technical community know what an agent is and how agent actions are abstracted into wallets. But I think no non-technical normal consumer wants to have to deal with mental gymnastics. And so from us, from our perspective, the wallet does 2 things. It contains and it lets you broadcast. Everything has to be in terms of very simple user experiences that use semantics that are everyday understandable. And so that's one thing we're obsessed about, which is why I wanted to put this stuff in those terms. I was going to say one other thing, but it just, absolutely escaped me. I think having said that, so the last thing I guess I'll offer here is part kind of our framing for go-to-market, and then also part a bit of a reflection about getting Portabl up and going is, we've now kind of really touched on multiple times that financial identity is not just this, it doesn't begin and end at origination. It begins at origination and continues for the life of the account, and then ostensibly 7 years after the life of the account. And so from our perspective, we asked ourselves, okay, we're not just an onboarding startup. We're not just a authentication company. Because we're merging a bunch of stuff, it makes us a compound startup. And so, as you can see on the slide, we're trying to move open banking to this sort of tap to prove era where identity transactions are consistent, but they're contextualized by what you're asking for at different points in the customer lifecycle. But to do this, we kind of went back to Parker Conrad's definition of a compound startup. And for a startup to be compound, there's 5 defining criteria. 1, does a startup combine point solutions to solve for an overtooled problem space? I think financial identity is inarguably an over-tooled problem space. Plenty of IDV providers, KYC providers, fraud, third-party lookup, so on and so forth. There's a lot going on. There's a lot of duct taping that happens. How do we compress some of those things into a single set of APIs? 2, common UX with shared components. This is one of the things we care about most, particularly from the consumer's perspective, is anytime you see that connect with Portabl button or prove with Portabl or connect with XYZ ID powered by Portabl, you know what is going to live behind that as a consumer, whether it's opening an account, approving a payment, encountering some sort of step up or progressive onboarding. The interactions are the same. And we try to establish those same set of expectations for the developer experience as well. You know what you're getting yourself into if you're setting up an issuance action, you know what you're getting yourself into when setting up, a verification action, stuff like that. 3, foundational data layer. Again, this all comes back to the DID and credential material. So again, because we're using the standards there, the foundational layer really comes down to what your credential manifest definitions are, i.e., are you requesting a lot or a little at different points in time wherever you're putting issuance or verification in your application, but it all comes from the same superset of available data, and that's what kind of makes things natively interoperable at the same time. 4, reducing complexity and costs. That's a no-brainer. Hey, if I can collect my SIP from my users in 6 seconds in one step instead of 3.5 minutes and 17 screens, that's great. That reduces complexity. It increases my top line. Oh, and now if I can get dynamically updated or near real-time user updates, that also solves for some of my cost problem as well. So by handling lifecycle issues and not just onboarding issues, that becomes a no-brainer for us. 5, solving a coordination problem across systems. There's 2 ways to read this. The first is that, hey, now my KYC ops can speak to my AML ops, can speak to my SIP and kind of ongoing ops, because we're all talking about the same person and we're all feeding from the same set of credentials that are permissioned on an as-needed basis. Great. That's the narrow way to read 5. The broader way to read 5 is about creating those trusted identity networks. Again, building large sets of trusted known users that drives down the cost of origination, drives down fraud incidents, so on and so forth. So solving coordination between different ecosystem players. Hey, if I'm X and I want to create an affiliate program with Y, folks writing the Portabl Rails are immediately known to me. The coordination between these 2 parties is now much simpler. And so, what that means for us is that tap to prove can be, contextually deployed across the entire lifecycle, because the primitives are the same underneath. It's the configuration that's contextually different, whether you're doing, did auth or OIDC for VP, a full KYC and SIP set with a complicated set of credentials and evidence, bit by bit step up, whether you're asking someone a year later to represent a credential, or whether you're asking for specific data like a user fork. Hey, if you're comfortable sharing X and Y, we'll personalize your experience. If not, cool. And then further out for us are things like loyalty and affiliates, and most pressingly, P2P. Authorized push payment fraud is a pain in everyone's neck right now. And with the increase in fraudulent identities, phishing scams, all that sort of malfeasance, there have to be other ways to very simply and predictably allow people to authenticate to each other before performing transactions. But again, same kind of tap to prove, it's just contextually different based on presentation definitions. So that's really what we think about quite a lot. It's how can we build simple ways to tackle a lot of these identity touch points throughout the entire life cycle, and use the fact that the standards that sit underneath are super, super flexible. But in doing so, we can create a lot of very consistent experiences from that account opening through refresh, through closing, through growth and beyond. So that's kind of our perspective on that. There's a much longer YouTube video that Parker Conrad has about what he thought about when starting Rippling and his definition of compound startup. Definitely would urge other founders out there to go take a look. But yeah, that's kind of the reflections we've had about how do we harmonize this idea of the fact that identity happens in a lot of different places. It's complicated. How do we compress a lot of adjacent functionality together to introduce simplicity and consistency across a life cycle, which is not necessarily very consistent in the status quo. So that's my piece on that. So, we've got a little bit of time left. Would love to field some other questions or anything you've had hanging in reserve.
Well, gosh, I mean, it sounds like in reducing that complexity for your customers, you are absorbing a lot of it, right? I mean, it sounds like harder than building any one of these point solutions by perhaps an order of magnitude. But of course the prize is so much greater. So has that been your experience? Like, has this been incredibly challenging compared to some of the other products that you've built, or actually are you finding enough synergy across these different touch points that it's working out?
It's a different kind of hard. So what I mean by that is I reflect quite often about the last job I had before getting Portabl started in business school. And I was one of the product leads at this company called Arachnus. It was in the QED portfolio. And we did KYB and KYC for mostly emerging markets, but we had a lot of international coverage. That was a lot of fun, but it was very difficult for very different reasons, largely because things like corporate directory information has not been uniformly digitized worldwide. So we did all sorts of insane things around building bots, building provisional APIs, working with like corporate registries of different countries and jurisdictions to try and turn things into data feeds where there were none. That was a different kind of hard. That was really like a data sourcing, data standardization sets of challenges. Getting identity to work using decentralized rails in open banking, it's much more of a product challenge than a tech challenge. I'll say that with a caveat, knowing that like it's still very early days for DIDs and VCs. OIDC is still like in its infancy, and we're learning a lot from all of that, plus things like IDaaS 2.0, UDARF, so on and so forth. It is still early days then, but kudos to the entire identity community for pouring their like blood, sweat, and tears into those standards. So that is like a great bit of community effort there. And so the onus on us is to build great products and abstractions around that sort of stuff that allow us to say, hey, all of these underlying standards that have been buffed and polished and sanded by innumerable people, here's how we crack it open for financial services because we have subject matter knowledge of things like KYC, AML, the Bank Secrecy Act, stuff like that. And we figured out a way to kind of chain stitch a lot of these different types of identity transactions together because we know the constraints and the intent of what the KYC officer, the AML or BSA officer need to be able to accomplish on the other end. And so the biggest thing that we're doing is finding the common denominator in the life cycle and saying, okay, deploy DIDs and VCs in this way, we can now create consistent interactions across this entire life cycle. And so it's very challenging to solve that as a product challenge. Though granted, there's a lot of engineering challenges underneath to make that happen. I would say it is more of a product challenge than an engineering challenge. So it's how do you build things that are intelligible to people, that use reliable experiences, that are not like so like far off based from like things people are normally accustomed to use. It's hard because you have to meet your buyers and your users where their today expectations are, not where their expectations are.
because I could see how this pitch is catnip for a CIO or head of transformation or something like this. They're going to grab it with both hands and be like, yes, this is the future of customer data. But that's not a wedge, is it? Right? That's for a startup, that's a 5-year like long sales journey. That's kind of incompatible with startup go to market. So that reconciling that big vision with enough concrete proof points along the way, it feels like that's a very central challenge that you're having to navigate.
Exactly. And that's why, coming back to something we mentioned at the top of the session, the first nibbles we're having are really around authentication, certifying trusted users, getting people off of passwords, and building effectively these like trusted user or like frequent flyery sort of programs built on the back of credentials, because that's the easiest step in, because there's not enough volume at scale yet to like overhaul onboarding and origination.
Yeah. Very cool.
Maybe just a quick question if we have 1 more minute. You mentioned tokenomics for a moment. I don't know if it's related to crypto tokenomics or like tokenomics like in gamification or just creating traction. But I mean, I think in relation to this, 2 questions. If related to crypto, what are your thoughts to crypto relationship to what you're doing, if any at all? And also, what is your business model? What do you expect your business model to be as you go into the future with this?
Yeah, so I'll answer those in the other order, if that's all right.
Sure.
So for the business model, it's really simple. It's usage-based pricing. You pay for what you use. There's sets of APIs that allow you to do specific functions around issuing, around verification. We're not in the business of like nickeling and diming you of like, if you need evidence, if you need like additional claims, things like that. It's going to be pretty flat, at least in the early days, because we're trying to remove as many kind of, cognitive friction barriers as possible to like getting in there, getting us stood up and implemented and giving us a test drive. So we wanted to make consumption as easy as possible. That now may be subject to change if we end up creating third-party data partnerships or other kind of issuer type partnerships where people can extend their profiles and use other types of stuff downstream. That stuff's subject to change. So that's the business model stuff. I think in terms of the crypto stuff, we here have certainly gone through an evolution. If you asked us this question like 18 months ago, I think we had much more of a like bridge between Web 2, Web 3 mentality. But over the past 18 months, we definitely pared that back to effectively zero, because we really, I think there's a lot of volatility in the crypto universe that took a lot of effort to just try and get our hands around. We said, okay, we could try and get our hands around this stuff, or we could play to our strengths and like figure out what is already like a $10+ billion market in the US, which is identity in the kind of strict traditional financial services context. We know that space, we know how it works, we have a line of sight into doing what we want to do. Okay, we should just focus on that. I think the other part too is that focusing on where the bulk of the users are, or end users, consumers are, made a lot more sense for us as well. So there's kind of this classical problem of like what's called straddling. It's like, do we try and figure out a way to build for both sides of the universe right now, or do you just kind of stick with one? And we realized, I would say about a year ago, to just like effectively cut the cord for crypto for the time being and focus specifically on identity for open finance in the more traditional sense. Having said that, now we have to cut our teeth in the traditional finance space, but there are still some bridges over to Web3 that we can start tapping into when the time is right. Whether that's changing up our DID methods, being cross-chain compatible, whether that's working with someone like an Oracle provider, for instance, or participating in a couple of other projects that are going on that allow verifiable credentials to be reconfirmed in an on-chain environment. those are all still active and ongoing. There's a lot of other smart groups of people working on those sorts of things. It's not our short-term focus. And we look at it this way. Look, if we get the financial identity stuff super, super right in the near term in kind of the open banking context, rebuilding the bridge over to Web3 and allowing people to bundle even more services, exchanges, what have you, into their wallets is not a far-fetched idea. And it's easier for us to go from mainstream universe into Web3 than it would have been to start in Web3 and then try to work our way backwards, both from like a technological perspective as well as like from an optics perspective, quite frankly.
Yep. Yeah, makes sense. Gosh, I'm just mindful of time, Nate. We've absolutely burned through this session, and it's been a fantastic discussion. And honestly, I've still got a bunch of questions I'd love to dig in with you, but I think this has been a mammoth episode, and I feel like we ought to bring it to a close. But gosh, thank you so much for sharing all of that great perspective on how your journey's been so far, and the way you're bringing together both sort of the old world of financial services and this brand new technology. I think it's super interesting, and we will definitely be wanting to catch up again in a few months' time and hear how you've been getting on.
Yes, certainly. I'd love to keep you guys apprised. You know, we have a big release in June. I think up till now, we've been doing a lot of stuff kind of stealthily, or at least pretty quietly, early adopters and build partners, though we are kind of waiting with bated breath for all hell to break loose next month when we release our public docs and our public SDKs and APIs like that and things like that. So we expect just like a flood of early adopter feedback from the development community, you know, small startups who may want to use our tools to embed financial identity straight away. And so, you know, we're excited for that to happen. It's a big milestone for us. We are definitely prepared for it to be maximally chaotic, but yeah, let's check in a few months and we'll share some more stories from then. But yeah, James, Alex, I can't thank you enough for having me on. This was a real joy, both to share with the broader community about like what we're up to, why doing SSI in financial services is playing on hard mode, and some of the things that some of the trade-offs we've had to really chew on quite deeply to, you know, basically make it work in an industry that is, you know, by and large, very traditional.
Amazing. Well, thanks again. And yeah, for everybody who's watching, what's the best way that they could get in touch with you or the team at Portabl, Nate, if they have further questions?
Yeah, if anyone out there has additional questions, feel free to email the team at hello@getportable.com. And then you can find me on Twitter and LinkedIn at Nate Soffio. Same handle everywhere.
Fantastic. Excellent. Well, I wish you the very best for the rest of your day. Alex, always a pleasure. And everyone, we hope to see you on the next episode sometime soon. Till then, bye now.
Thanks very much. Bye-bye.